Silver's fundamentals have become much more positive. Not only is there a tremendous drop in the supply, and I'm not even talking about arguments of shorting and all this, the very fact, and it appears to be correct, a lot of good sources seem to be identifying this, that even China now is going out and buying silver directly from producers around the world and so forth and so on. And yeah, you're right. I think people get too caught up about that old high and, about being down. I think it's performed better than most people give it credit to, but I still think it will always, unfortunately, be just behind gold in terms of recognition, particularly among institutional. It's more of a retail love for it than you'll see in the gold market.
Although silver has outperformed gold year to date in 2024 and over the past 5 years, that hasn't always been the case. Gold historically outperforms silver in the long run and has delivered an annualized 7.7% return over the past decade. Meanwhile, silver has only delivered an annualized 6.08% return during the same stretch. China's increasing silver consumption in the solar sector and renewable technologies have driven much of the recent demand surge. Solar energy now accounts for 16% of the silver demand compared to 6% in 2015. Renowned financial expert Peter Grandich underscores silver's improved fundamentals, noting its growing appeal among retail investors. While historically secondary to gold, silver's market position has strengthened in recent years. From a technical standpoint, Grandich mentions a decline in the global silver supply and rising Chinese purchases, boosting its appeal. Gold is the more established asset, but in 2024, silver has outperformed the yellow metal year to date and over the past 5 years. Several key factors have bolstered silver this year, including strong industrial demand in the face of persistent supply deficits and increased investment interest amid economic uncertainty. While reflecting on the market, Peter Grandich highlights the growing influence of BRICS, predicting its expansion as countries seek alternatives to U.S. dominance. He sees central banks' gold purchases as preparation for a shift away from the dollar. Furthermore, central banks worldwide have been accumulating gold reserves at an accelerated pace, with demand for gold surging by 152% year-over-year in 2022, marking the highest level since 1950. Now, we present the clips of Peter Grandich's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Silver always has been a more cult-like metal than gold.
Yeah.
As you said, there are gold bugs, but silver bugs are even more stronger and more adamant about it and all. And I know that because I used to say at the shows, boy, this used to get me in trouble, but I used to say it all the time. Owning silver is like kissing your sister, and compared to owning gold. And for a lot of years, that was the case. But silver's fundamentals have become much more positive. Not only is there a tremendous drop in the supply, and I'm not even talking about arguments of shorting and all this, the very fact, and it appears to be correct, a lot of good sources seem to be identifying this, that even China now is going out and buying silver directly from producers around the world and so forth and so on. And yeah, you're right. I think people get too caught up about that old high and, about being down. I think it's performed better than most people give it credit to, but I still think it will always, unfortunately, be just behind gold in terms of recognition, particularly among institutional. It's more of a retail love for it than you'll see in the gold market. I've been a huge bull on the BRICS when almost no one was talking about it, other than our friend Andy Sheckman, who always kept my bullishness on fire. I think it's real. I think we're seeing that change in the world. I think that's the main reason all the central banks have bought so much gold, Jesse, is because they see the change coming in the world with monetary systems, and the United States and the dollar is basically seen its peak. It's only going to get less and less. And as much as Trump's flustering now might give people some hope that that's going to turn around yet again, I think the BRIC situation is inevitable. And so I think we better learn to understand that we are not the big guy with the big stick anymore, even though you might feel that way for a few months into Trump's presidency. And the BRICS will still be a formidable force, and we'll see more countries, especially now that we've gone ahead and we've taken the Russian money and we've taken the interest and we've given it to it. And we see now the threats of tariffs. Privately, you have to understand that the leaders that are trying to get BRICS moving forward are turning to these countries and going, listen to what Trump wants to do. He wants to ban you, be no involvement, throw you out. You want to be with that? You want to be with us? We're the new kids on the block. And I think he really created an extra marketing tool for the bricks, but we won't see that until next fall to see how many move forward. And I believe it's going to be a substantial amount move forward with the brick movement.
Over the past year, the significant gap between gold and gold equities had been narrowing. However, the post-election weakness in the gold sector has widened it again. This disconnect may not last forever, with gold producers enjoying record margins and generating substantial free cash flow. Based on fundamentals, Peter Grandich emphasizes challenges in the junior resource market, including competition from cryptocurrencies and fewer financial advisors promoting junior stocks. He also notes a sharp decline in institutional interest, reduced brokerage support, and mining desks. Despite these obstacles, Grandich states positive trends among mid-tier and major mining companies. He predicts a surge in acquisitions in 2025, as large producers must replenish their reserves by purchasing juniors with advanced stage projects or production potential. A weaker gold price led to gold equities underperforming the metal in November. The NYSE Arca Gold Miners Index was down 7.09%, and the small or mid-cap index, the MVIS Global Juniors Gold Miners Index, was down 7.79% during the month. Gold equities are now lagging gold this year, which is surprising. This is believed to be the compounding result of market dislocations in valuing the gold equities over the past several years. For transparency, note that as of December 17, 2024, over the past 5 years, GDM NTR was up 43.45% and MVGDX JTR was up 31.58%. Let's get back to the interview.
Bullion's done real well. If you just owned the bullion, which I did, a part of my portfolio did really well. But I was part of that other crowd that also owned the shares and was going, how come these shares are so bad compared to what the metals are doing? And that's what people have not been satisfied about the gold performance. Because anybody that recognizes 30% a year in gold price going up is a phenomenal move.
Yeah.
The majors, for most of them, you mentioned two that aren't doing so good. Newmont has some issues to deal with, Barrick, but then of course you went to the other side. Agnico Eagle is just a phenomenal company right now. IM Gold's even turning around in Canada. They're printing money now in free cash flow. And you can already see the increase now in their M&A, and I think that's going to be big for the juniors. But let me tell you the two biggest issues that the junior market is. My portfolio right now is cash and junior resource stocks. And by the way, 99% of the people listening to this should not be doing that. For me, it's doable at this point. But here's the biggest challenges for the junior resource market, the two biggest ones. And you have to accept it and deal with it. One is crypto continues to eat its lunch. I would say that 20 or 30 years ago, if I went and spoke at the typical gold shows, like the ones that you've been involved with and all, there were a lot of 30, 35-year-old, even 25-year-old investors there looking at junior resource stocks. They're at the crypto conferences. They're not to a large degree. So crypto continues to be strong competition, keeping money that might have flowed to juniors. The other big thing, and this is what a lot of people don't want to speak about, even in the industry, but this is part A and part B, are really critical. First of all, that end user, that person that ends up buying these junior stocks, not just those people I told you that are no longer showing up, they used to be basically led by a leader. And that leader was a typical financial advisor who built a book of business owning these junior stocks. And therefore, if that Acme Resources got Peter Grandich interested, you got my 100 to 500 clients involved. Basically, no financial advisor builds a book of business around individual stocks anymore because there's no commissions anymore. A few may do it under a money management program, fee-based and all. So that was that. Even if all those end users still exist, Jesse, and I don't think they did, and I'm going to tell you another group why I think there's less people now than 10 or 20 years ago, that mining junior has to get to those individuals almost on a case-by-case basis now. So where it's been like programs like yours and others where people have a following commodities, so those juniors try to get involved in those companies so they can speak. But it's a much bigger challenge from a marketing standpoint. But here's the biggest part. The institutional interest in juniors has shrunk tremendously. There might have been in Canada, just Canada, which was used to be the home for, junior resource stocks, 40 or 50 leading brokerage houses, mining desks, whatever you want to call them. Maybe there's 5 now, 6, and maybe 20% of the people, manpower that used to make up those teams are left. They have very little new money coming into their funds. So all of this has been a negative. And yet, juniors have to keep raising money. They have to find people and so forth. We're just starting to see a light at the end of the tunnel that isn't another bear train heading to us. We're finally seeing a marked increase in financings being oversubscribed, more people starting to talk about the mid tiers and all. But the key is this: the majors who are printing money, like I said, free cash flow. We just saw a record low amount of dollars that they are putting to grassroots exploration. So if they're going to replenish the millions of ounces of years of gold and other metals that they take out of the ground and produce, they are going to have to go on a shopping spree, because it's going to take too long and too much money to try to get that. And now with so many juniors with advanced stage explorations and some in development and even some starting to produce, still at 10 to 40 or no more than $50 an ounce marked in the ground based on their market cap, we're going to see huge M&A in 2025. We already started to see it the last couple of weeks. We just saw Agno Eagle do a big deal yesterday. An all-cash deal, 67% above the average trading of the stock. That's a really, really good sign for 2025.
Rising industrial demand from green technologies and limited supply growth position silver favorably in a rapidly changing economic landscape. Silver's undervaluation relative to gold and its strategic role in renewable energy applications adds to its appeal. In particular, silver might rise to $100 in the time frame 2027 and 2028. What are your thoughts on Peter Grandich's insights regarding silver's evolving role in the face of changing global economic trends? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.